Assalamualaikum to all the viewers. Here I am Benazir Hakro, the student of the Department of Business Administration from Sindh University campus Larkana. I know nowadays you have a mixed feelings considering the pandemic we are facing. But it is saying goes that there is no stop in the learning. That's why I am here for presenting this video lecture for my final examination. As per my timetable schedule, today I will discuss on 4 important topics. Number first, what is insurance and principle of insurance. Number second, what is life insurance. Number third, types of life insurance. And number fourth is benefit of life insurance. This video lecture is supervised by Madam Indra Mughal. Let's start the lecture from what is insurance. Insurance is a protection against financial losses arising on happening of unexpected events. It provides indemnification against various losses. Insurance is a contract between the insurer and insured, whereby the insurer agrees to compensate the insured against loss, and the insured has to pay a certain fixed sum of money on timely basis to the insurer. Insurer work is to protect financially from unexpected events. There are two parties in insurance. First, insurer, who issue the insurance policy. Second, insured, with whom insurance contract is made. Now let's understand the principle of insurance. Number first, principle of Uberina Fide. The insurance contract must be signed by both parties, that is insurer and insured, in an absolute good faith or trust. Means, according to this principle, insurance must sign with good faith, mean there should be honesty and truth in both parties. Insurer and insured should clearly, completely or correctly disclose the whole material fact related to subject matter. There should be no any kind of mispresentation, non-disclosure or any kind of fraud. In case related to subject matter, any fact is hide, false or may be present in a wrong manner, then insurer have legally right to cancel the contract. Also in this case, their liability will be void. For example, in life insurance, insurance companies are trying to make sure that insured have no any kind of disease. But when Mr. Ali got his insurance policy, then he didn't tell about his heart surgery to insurance. After his death, insurance company known about Mr. Ali didn't have a correct and complete information to the insurance. So in this case, insurance can refuse for giving any kind of compensation to Mr. Ali's family. Now move on the next principle, that is principle of insurable interest. The insured person must suffer from financial losses by the damage of the insured object. For example, Mr. Ali is the owner of taxi and he insured his taxi, means he has interest in his car because he earned his income from the taxi. If he sold his car, then he will have no insurable interest in his taxi. Then we can calculate and evaluate the insurable interest because the insured person have a ownership is important. Now principle of indemnity. According to the principle of indemnity, an insurance contract is signed only for getting protection against unpredicting financial losses arising due to the future uncertainties. In an insurance contract, the amount of compensation paid is in a proportion to the incurred losses. Indemnity means security, protection and compensation given against the damage, loss or injury. So, insurance company gave compensation cannot be more than actual damage. For example, Mr. Ali's building value is 5 lakh and he insured his building in 4 lakh. For suppose building will have got a fire, in that condition building suffer the loss of 2 lakh. Then insurance company will provide 2 lakh for loss because insurance just compensate only the actual loss of 2 lakh, not more. Another principle is subrogation. When the insured is compensated for the losses due to damage to his insured property, then the ownership right of such property shift to the insurer. Subrogation means transfer of rights and remedies from insured to insurer. This principle will be applicable in the case of when we guard value of damaged property and insurer can guard profit which he compensate to insured. For example, Mr. Ali has a car which was stolen and Mr. Ali complained the file in a local station. When he got a report from police station, then insurance company gave compensation of car to Mr. Ali. After that, when police find out the car, in this situation now Mr. Ali have no right on his car because he already subrogated. Means ownership and rights are transferred to insurance. Now insurance have right to do anything. Now another principle is contribution. If the insured claim full amount of compensation from one insurer, then he cannot claim the same compensation from the other insurer and make a profit. This principle applied on all the indemnity contract where insured have more than one subject matter policies. According to the principle, insured can claim to compensation only for use amount if also he got the multiple policies. For example, Mr. Ali buy a fire insurance for his house from different companies. From company A 30,000, from company B 30,000. If Mr. Ali got loss of his property for 50,000, then in this case both companies compensate equally, means only 50,000. If Mr. Ali claim for 50,000 from one company, then he cannot claim to other company. Now the principle of mitigation of loss. The insured must not neglect and behave irresponsibility during such event just because of property is insured. According to this principle, insured person have tried to minimize the loss. Fire outbreak or blast. Insured also have duty. In this case, he has to minimize the loss, means he take a possible step to show up responsibility, not irresponsibility. For example, due to short circuit in Mr. Ali's house have got a fire, then control on spreading of fire, take a possible steps. Don't think that I have insured to house. So don't be careless and inactive. Now the last principle of causa proxima. The principle of proxima, that is nearest or the closest cause, should be taken into consideration to decide the liability of the insurer. This principle tell you that if you find out that insurer is liable for loss or not. So in this you have to see the closest event. For example, Mr. Ali got a policy of seawater for cargo ship. After some time there will be hole in cargo ship. So seawater is entered in the ship. Then due to the hole, leakage will be occur and all the goods are spoiled. So insurer have to bear all the loss and try to know the reasons, because seawater is only the reason of loss. Let's define the next topic, that is life insurance. We know that insurance is a product designed to provide a measure of protection, at least financially should disaster happen. So life insurance is specially designed to protect financially to your beneficiaries when you pass away one day. So what actually life insurance and how does it work? Life insurance is a contract between insurer and policyholder in which the insurer guarantee payment of death benefits to the named beneficiaries upon the death of insurer. For example, you pay a some amount of money called the premium to the insurer, and when you pass away, your beneficiaries, usually your family members, get a lump sum amount of money called the death benefit. Now the next question is, should you buy a life insurance? You should buy a life insurance if you have anyone who is depend on you financially support. For example, your kids are elderly parents. However, if there is no one that require you support financially of life insurance, then don't buy this. Now have a look on a typical example of life insurance. We have a John, a 50-year-old sole breadwinner of a family with a wife and two lovely kids. Like most families, John have a property on mortgage, 20,000 decide cash and some amount of owe from credit or debit of $20,000. For suppose if one day John will be pass away, then his estate will be distributed. Firstly, 20,000 cash might be taken away by his creditor. Secondly, because he is only working in a family, his property on mortgage might be taken away as well. This leaves a wife and only two kids. No shelter, no money for surviving. His kids might also be in a college and will be deprived of the needed fund of the education. But wait, can all these problems avoided? If only if John had a little life insurance. So also have a look on what happens if John did purchase a life insurance. If John did purchase a life insurance, his commitment will be to set aside a portion of his income and give it as a premium to XYZ insurance company. For suppose if John will die, then XYZ insurance company will provide a John family a lump sum that is called death benefit, which will go to his family. Now this lump sum money can be used to pay off mortgage loan, family's expenses, and most jurisdiction this sum of money has been protected from creditors. His children now also have required money to go to college. So you see why life insurance is important to everyone with a dependent. Now types of life insurance and benefits of life insurance. There are 6 types of insurance: term insurance, whole life insurance, endowment plan, ULIP, money back plan, annuity and pension plan. Let's understand in detail. I am telling you here why you buy these policies and what benefits are in them. Number first, term cover or term insurance. It is pure insurance product. In this policy, there is no option of saving or profit. For suppose anyone buy a 1 crore term insurance and he will die, then insurance company will give insured amount, mean just 1 crore. If policyholder is alive, then company will give no any amount. That's why in comparison of insurance, it has less premium and gave more insurance cover. People often say that if we will not receive any premium, then it is harmful. But think out one thing, in some thousand you are insuring a lot of thousand policy. Now benefits of term insurance. Given less amount of premium to insured high amount policy, it will best option of term insurance. Remember that if you start quickly, then you will pay less amount of premium and will be same premium for lifetime which was in first year. Second one is whole life insurance. It is also like term insurance, but this type of cover will give you for lifetime. But for this cover you pay a higher premium. Now benefits of whole life insurance. With whole life insurance benefit, also term insurance, and its all benefits are for lifetime. Now third term is endowment plan. In endowment plan we also get benefit of saving. There are 2 options in this. In policy period, if policy holder will die, then insurance will give some insured amount to his family. Or if after completion of policy period, if policy holder is alive, then insurance gives some insured amount plus bonus. In this there are high charges of premium and also have a less risk. And also we get less returns. This is our traditional insurance plan which we see from many years. Benefit of endowment plan. In endowment plan, on maturity you can earn decent benefit and less risk. It is best product for long term plan. Now fourth one is money back plan. It is also like a endowment plan. In this cover policy holder get a some percent in every year. And also insurance provide bonuses to money back plan policy holders. Now benefits of money back plan. This is a base product for short term plan. Also you can earn maturity returns. Now fourth one is ULIP. It stands for Unit Linked Insurance Plan. In this plan with insurance also we can receive investment benefits. When you purchase ULIP, then you have option that where you want to spend your premium in debit market or equity market. Because when you purchase policy, you can decide where you want to invest your money. In this policy, there are high charges in ULIP. But if you choose equity option, then you get returns for long term. But these returns depend on your selected funds. Now benefits of ULIP. In this you have to invest for long term, then you can earn high return from others. Last type of insurance is annuity or pension plan. This one is different from other product. Like continuous pension, if you want to earn regular income, then this product is best. You have to pay the premium at a time, then you can earn monthly, quarterly or annually pension. The benefit of pension plan. In this, your retirement plan will be better. Now we can understand what benefits are in these policies. First benefit is you can identify your policy which you have, and also you can understand that either you are earning profit or not. And second thing, in future, any agent want to sell his policy, then don't believe on him. But according to your requirement, you can buy your right policy. Now let's think about your future today and not in your future. In last, I'm thankful to all of you who are watching my video. Thanks for watching, and please do not forget like and subscribe to my channel. Thanks a lot. Allah Negeban.